Good day everyone, my name is Jamaica Anjibatan and I am the second reporter, and this is the continuation of our report. My topic is all about product profitability analysis. Product profitability analysis is the process of linking a company's overall profit back to the profit of a specific product. A company's overall profit is the money they have left at the end of the accounting period after subtracting total cost from total revenue. So, for example, the frame company makes many sizes, shapes, and colors of a picture frame. At the end of the first quarter, the frame company calculates their overall profit as 15%. This means that they are making 50 cents of each dollar of revenue. Business managers use accounting data to perform profitability analysis of their companies. So when the data is inaccurate or incomplete, the analysis are flawed. So, ayun. There are three main reasons for inaccurate or incomplete data. First is inconsistent record keeping, second, inaccurate inventory costing system, and third, problems consolidating data from subsidiaries. Inconsistent record keeping. Each fitter sales division maintains its own records and tracks sales data differently. For the whole sales division, the accountant could run sales summary reports for each state in the Mid-Atlantic region by month. The production uses paper records, so the data must be taken from paper records and entered into a spreadsheet. With an ERP system, both divisions record and store their data in the same database. Then the questions regarding company's performance can be answered in a minute. Excuse me. So Engage Learning reserves the right to remove additional content at any time if subsequent rights restrictions need to be placed into place. So next is inaccurate inventory costing system. Inspecting inventory cost is one of the most important and challenging accounting tasks. Managers need to know how much it costs to make an individual products, so they can identify which product are profitable and which are not. An ERP system can help improve the accuracy of inventory cost accounting. So finally, we will discuss the rationale behind activity based on costing as a method to further improve the accuracy of inventory cost accounting. So, inventory cost accounting background. A manufactured item's cost has three elements. Una, the cost of raw materials. Second, the cost of labor employed directly in the production of the item. And third, all other costs, which are typically called overhead. Manufacturing overhead costs include factory utilities, general labor, which is the security guards, factory manager's salary, storage, insurance, and other manufacturing related costs. Material and labor are often called direct costs kasi nga the constituently amounts of each in a finished product can be estimated fairly and accurately. Pero, the overhead items are difficult to associate with a specific product or batch of a product. A common method is to use the total machine on the assumption that overhead is incurred to run the machines that make the products. With this approach, overhead costs for a certain time period are added up, then divided by the total machine hours for that time period to get the overhead per machine hour rate. Itong value na to, ginagamit siya para ma-allocate yung overhead cost to products. Suppose that fitter used this approach and calculated its overhead rate at $1,000 per machine hour. So If fitter can make 10,000 bars in an hour, then each bar would be allocate $0.10 of overhead. Kasi nga, 1,000 divided by 10,000 bars is equal to 0.10. Overhead can also be allocated to a product using direct labor hours of material cost. Si company ang nagde-decide on how to allocate overhead cost based on what makes the most sense in its production environment. Adjustments must be made to the accounts to show the actual cost of inventory owned on the balance sheet and sold on the income statement. Companies such as Fitter that produce goods for inventory typically record the cost of manufacturing during a period using a standard cost. Standards are established by studying historical direct and indirect cost patterns in a company. The inventory account would be reduced by $600,000 because the company no longer has those units to sell. If actual cost in the month equals standard cost, no balance sheets or income statements adjustment would be needed. Actual cost never exactly equal expected cost. However, adjustments are almost needed. So if the company keeps records for the various elements separately, compiling variance adjustment can be difficult. If products are made by assembled parts that are made at different manufacturing sites, and the sites use different information system, the adjustment may be very imprecise. ERP and inventory cost accounting. Many companies with an integrated accounting system analyze their cost variance infrequently. So knowing precisely how much production cost can be very important. So suppose that Fitter has a opportunity to sell 300,000 NRGA bars to a new customer. This is a huge order for Fitter. The customer wants the price of 0.90 per bar. Fitter standards cost per bar is currently 0.75 based on information that it's 2 months old. Fitter knows that the cost of manufacturing snack bars have been increasing significantly in the past few months. So Fitter does not want to sell at a loss per unit, pero he doesn't want to lose a large order of a potential good long-term customer. Because of the difficulty of compiling all the data to calculate cost variance, Fitter only analyze cost variance quarterly, and new data will not be available for another month. Should Fitter accept the large order? If Fitter had an ERP system, employees would have record cost in the company-wide database. The system could compute variance automatically when needed. Product costing example. Fitter cost accountants have calculated new overhead rates for its NRGA bars. The new rate for production overhead is 100% of direct material cost because the material costs are much larger than direct labor cost. At Fitter, the company has decided to apply production overhead as a percentage. So in figure 5 to 8 shows that the product cost analysis for the NRGA bar, the cost analysis is based on 7 cases of bars, which is the amount of bars that can be produced by a 500-pound batch. This information is repeatedly in the cost analysis of each the material listed below. So ayan, as we can see, for example, the per pound cost of oats is $0.20. So to get the material, we have to multiply the number of material by the unit cost gives the direct material cost for that ingredient item. Therefore, the total direct material cost of oats is $60. Kaya siya naging $60 because 300 times 0.20 is equal to 60. So summing the result of for all the ingredients gives a total direct material cost of 537.65 as we can see here in the table. For a 500-pound batch, applying the production overhead rate of 100% to this direct material cost gives a production overhead cost equal to direct material cost, or the $537.65. So as shown in figure 5.8, the direct labor cost to mix the dough and bake the snack bars is, as we can see here, is 54.50. It is important to note that the labor cost is only about 10% lang of the direct material cost, which is why Fitter has chosen to apply production overhead cost based on the direct material only. The sum of the direct materials production overhead and direct labor is the cost of goods. Manufactured or COGM, currently Fitters use a rate of 30% of the cost of goods manufactured to estimate the sales and administrative cost. So adding the sales and administrative cost to the COG gives the cost of goods sold, COGS. So to get kaya nakuha itong 1,129.80. Add the total direct material cost, which is the $537.65 plus the production overhead cost, which is the $537.65 plus the direct labor, which is the 54.50. It is equal to 1,129.80, which is the COGM. Because the COGM and the COGS were estimated based on the BOM or the recipe from Chapter 4 that produced 7 cases of snack bars, figures must be divided by 7 to give the COGM and the COGS on a per case basis. In figure 5 to 8 shows that these are $161.40 and $209.82 respectively. The product cost analysis allows you to determine whether selling 300,000 NRGA bars to a new customer for a price of 0.90 per bar would earn a profit for Fitter. So, given that there are 24 bars in a box and 12 boxes in a case, the current cost of an NRGA bar is $0.73. To get this, we have to divide the COGS per case, which is the $209.82 divided by the 24 bars divided by the 12 bucks, so it is equal to $0.73. So based on this calculation, we can see that Fitter can sell the bars at $0.90 and make a profit of $0.17 per bar.